Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Tuesday, March 4th. When Intel provided its first quarter guidance in mid-January, it warned that it was taking a conservative line on things due in part to the weak NAND flash memory pricing environment. Its attention to U.S. economic indicators, which had been flashing slowdown signals, was the other driving factor. After Monday's close, Intel provided updated guidance that qualifies as a disappointment. Interestingly, the company didn't say anything about economic indicators in the U.S., as it pinned a downward revision to its gross margin guidance solely on lower than expected prices for NAND flash memory chips. Intel did not clarify if the price deterioration was a function of reduced demand or simply excess supply from industry manufacturers. Either way, Intel now expects its first quarter gross margin rate to be 54% plus or minus a point versus prior guidance of 56% plus or minus a couple of points. The company did not make any other changes to the business outlook it provided following its fourth quarter report. That means it did not adjust its revenue guidance of $9.4 billion to $10 billion. Still, the gross margin guidance will prompt some downward revisions to analysts' EPS estimates for the first quarter. Intel stock has held up reasonably well in light of the disappointment. Losses have been tempered by the recognition that Intel was not overly priced to begin with at 14 times estimated 2008 earnings, as well as the understanding that PC demand, which is the core driver for its overall operations, is holding up fairly well. All things considered, we'd continue to hold the stock here. However, given the market's misgivings about the economic and demand outlook, we'd refrain from committing new money just yet. Incidentally, Intel will be holding an Analyst Day on Wednesday, March 5th. I'm Pat O'Hare for Briefing.com. Thanks for listening.